Welcome to BeFi Insight Briefings. Today we're exploring generational nuances and biases that impact advisor-investor relationships. Coming out of the pandemic, we noticed that there is a widespread increase in observed behavioral biases, especially by generation. I'm Devin Eckberg, and with me is our BeFi Barometer partner, Omar Aguilar. Omar, as we dive into the behavioral finance research from the past year, I was wondering, what are your thoughts on why we have seen these generational tendencies play out more predominantly during this period?
This is a fascinating time to work on this. I cannot, think of a better time for anybody that can understand, how generations get affected by events that we have seen over the last 3 years. Let me share some insights. Across the board, we tend to see individuals impacted by their experience or psychological experiences over the course of their lifetime. For example, millennials and individuals from the silent generation tend to have more in common than what we all think. It makes sense to see that the silent generation and millennials have a lot of things in common because their experience as they grow up are very, very similar. And what we have learned in concepts of behaviors and learning and training is that in many cases, those experiences tend to have, an influence on how they make decisions. For example, the Depression had a significant impact in the behavior of silent generation. They learn to hoard materials and to hold on to everything they have, especially savings, rather than trying to take any risk. What the influence of the Depression and the World War II was something about scarcity of resources, money, and more, resulting in a significant level of risk aversion. And in many cases, delaying purchases and any decisions because there was a significant amount of uncertainty around the future. If you look about the millennials' experience, it is something very similar in a different part of life. When they saw their parents lose investments, they saw their parents go up and down with different crises. They saw how the dot-com bust, the housing market crisis, the experience in the financial crisis of 2008, and in many cases, these ups and downs influenced their own careers. And just like the silent generations, millennials struggled to find work when they graduated, and they got married and started to just figure out that there was not a significant of abundance during those time periods. If you go back to the other side of the generation, so the Generation X's, they tend to pay a lot more close attention to economic issues that impact their earnings and savings. As they lived through the stock market crash in the late 80s and remembered family struggles that they have of the accumulating wealth overnight, they tend to be more influenced by creating and maintaining their financial status, having enough money to retire on their own terms, and ensure that they have put enough money away to live comfortably through retirement. Baby boomers, which is still the largest generation that we have had, are less risk averse because they grew up influenced by abundance of opportunities around them. They are entrepreneurials by nature. Opportunities such as access to higher education, companies offering pension plans, the rise of new industries such as space exploration, explosion of technology, Silicon Valley, at the end of the Cold War, everything that they observed, including the expansion of international relations and globalization, basically gave baby boomers a sense of overconfidence and a sense of trying to continue to take risk in the marketplace. So when we actually put all these pieces together, so what behavioral finance tells us is that it is critical to understand the significance that advisors may have when they're dealing with different generations. Advisors need to build a way to communicate with generations by creating a map to help them understand the differences, biases that they have across their clients and how they may change from generation to generation. This is a critical skill for them to learn. Advisors should identify their clients and what their financial drivers are and use a combination of strategic goal-setting meetings and helpful questionnaires. Trust is a big concept across generations. Advisors need to build their relationships and establish a foundation of trust based on active listening and accommodating their biases. understanding the importance of generations and the difference in biases across generations is critical for building that trust.
And the research really just wrapped all of that up for us. We understood from the research that millennials who were raised in the digital age have an abundance of information at their fingertips, so they are more comfortable with online investing tools and apps, and so they incorporate the use of technology, apps, and text messaging into an advisor's repertoire. And Generation Xers are hyper focused on having sufficient money to live comfortably, so help them out with their retirement savings and plans and strategies. Don't forget about the Generation X. Baby boomers are more focused on having enough income for the future because they're beginning to move into the retirement phase of their lives. So advisors should ensure that you can help them in transition from the accumulation of money to the distribution of it instead. And the silent generation are often dealing with the decumulation of assets already. They're identifying channels and avenues to sustain them through their retirement and having healthcare plans in place and providing for them and their spouses as they need support, as well as looking at generational wealth transfer. So for more advice from some of our leading behavioral finance experts, check out our BeFi Insight Briefings at the Investments and Wealth Institute, or visit our website for more resources and tools to help you improve your client outcomes.